Hey, this is Sasha, and welcome to another episode on Let's Talk Stocks. And today what I want to do is show you a cheap shot, meaning taking a stab at the market, putting on a low-risk trade for less than $100. So we're going to do this with a butterfly spread. I think it's the most cost-effective way to kind of take a stab at the market or taking a shot directionally. So why don't we go to the screen and I'll show you the trade setup that I have. And before we do though, just keep in mind that I'm pre-recording this video, so you're probably watching this a couple weeks into the future. But just understand that you can go ahead and set up these types of trades if you're looking for some speculative thoughts and ideas. The whole point and concept is to learn the theory, the concept, the ideas, and then give it a shot, give it a test, and see how it pans out. Now, you wouldn't do these kinds of trades with your full capital amount. These are speculative trades, meaning kind of, hey, take a few dollars and maybe give it a shot, and sometimes they'll work out and sometimes they won't. So let's take a look and I'll give you some thoughts on how you can put on an option trade for less than $100. In fact, it's actually just $55 at this exact point. So here, what I've done is basically looking at a butterfly spread. And if I'm looking at the S&P, if this is what I'm doing, I went out 37 days from today, and today is June 11th, so you'll probably be watching this a week or two into the future. And when I went ahead and put this trade on, what I was doing was looking at the VIX. You know, it's 15.91 right now, and if you look at the S&P, the reason why you may want to do this type of trade is look at it like this, and here's a thought and idea. This market has been going up, up, up for like 5 or 6 days in a row, and if you're expecting a little pullback, even if it's 30, 40 points, something like this, like a cheap shot, could work. And since you'll be watching this later in the future, you might actually be able to see if this pans out. Now, this may or may not work, but hey, I'm risking $55. It's a cheap shot. Of course, you could go ahead and bump up a couple of contracts. So let's say I do 2 or 3 contracts, then I'm risking about $110. So for about $100 right here, I could go on, put 2 contracts. And what this does is what I'm doing, and you can see here's a 2810. I went with a 2810 on the July. I've bought those for protection, sold the 2790, and bought the 2770, all on the put side. So if you're looking at it, the one that I sold was the 2790. So the 2790 compared to our current price is a little further out. Okay, so it's, let me show you that. It is right here, and our at the money is way over here, so about 2,900. So it's a pretty good spread, basically about 100 points away. But, you know, if you just pull back 3 days or 1 or 2 days, the market or our trade doesn't have to go all the way there. It could just come all the way here, and you could still profit a little bit. So looking at it, what happens and what's good about these butterfly spreads is they're cheap to put on. So you can see that it's, you know, between about 110, 120 for 2 contracts. And after a few days, you know, the theta starts to kick in. And remember, we got about 37 days. So we could just almost let this sit for a while. And now you see this curvature starting to ramp up. Okay, so notice this white line starts to ramp up. So if this just kind of stays and hangs out here, well, you know, I might be out $55. If it continues to move up, I'll be out $55. Again, doing 2 contracts, I'd be out about $110. If it does pull back, well, I don't really need it to pull back all the way to 27.90. Really, if it goes to even 28.30, well, on my $110 investment, I make about 3 times that money. I make about $320. If it goes to about 28.20, I make about $370. So looking at this trade and setup, selling the 2790s, 4 of them, buying the 2810s, the puts, and buying the 2770s, you know, you're paying 55 cents for the trade. So I did 2 sets of those. And here's how that trade would look, and there's kind of a setup idea for you. And the reason why I might do a trade like this is because we've been just heading up for quite a while. Could we continue heading higher to 29.50? Yeah, absolutely. We could go to 29.50 and then I'm out my $110. But in this case, well, you know, 110 is not too bad to take a shot, a stab, an idea. Of course, if you ramp it up, for those of you that are wanting to trade a little bit larger, let's say you're doing a 10 to 20 spread or a 20-10 spread, you're putting in, let's say, $550 or $600 here on the spread, you know, with a possible chance of making about $1,600 if that works out. So it's kind of, you could use this as a little insurance idea as well. You could use it as maybe just a speculative idea, but again, I would just be cautious. Be cautious putting these things on. You don't, you know, put these on every single week, but if you're trying to take a stab, you're coming into all-time market highs, you know, and you had like 5 or 6 days all in a row without a red day, you know, something like this could be an interesting play. You could also do this on the upside if you know, things were going down and then you thought, hey, it'll counter trend bounce. You could do that as well. Or even if you think things are going to continue heading higher, you could do speculative plays like that as well. But here's a thought idea for you, and maybe you got some insight out of it, because you know, it's a cheap way to speculate. It's a cheap way to take a stab. You can do these kinds of things on earnings trade. And if you're just doing a single contract, if you're just experimenting with options and you put something like this on, well, let me show you what that looks like. Well, at most, you're really risking $55. And you don't have to, you know, let this trade expire. You could take it off early. If it does kind of just hang around there for a few days, that's actually better for you. If it happens immediately, it actually may not be as good, because that theta decay doesn't have time to kick in. So that's why, you know, putting this on, you could do it, you know, in this case, 37 days. If you think it's going to happen much sooner, I could go ahead and, let's say, do it maybe July 1st, maybe 15 days, June 26th even, because watch how quickly that theta starts to kick in if I do it that way. And you don't have to spend as much. So here is June 26th. There you go. And you can see here I'm spending about $50. If we go to June 19th, I'm spending, again, almost about the same amount, but the theta decay will kick in way quicker. So again, if I just go a couple days into it, you can see, boom, and then I'd be out my money if the trade doesn't work out. So anyways, sometimes it's not even worth the commissions to sell these back. You just let them expire, and that's kind of the end of it. Anyway, so that's an idea for you. Hope it gives you some things to think about. Hey, it's an interesting concept. It's not something, you know, you may want to do every single day, every trade, but it's another tool in your toolbox. So thank you so much for joining me. Hope you enjoyed this video. And if you did and you want to subscribe, then join the YouTube channel by hitting this face icon right here, or get on the newsletter list by going here, enter your name and email address. And when you get there, you'll be signed up to the newsletter. So that way you can receive news announcements for courses, products, books, and other good stuff. Thanks again, and I'll see you next time.